The news cycle wants you to look at the handcuffs. They want you to focus on the plane landing in New York. They want you to debate the politics of a single arrest. But while the world is arguing about one man, the United States just quietly activated a weapon far more powerful than any aircraft carrier. What happened in Venezuela is not just about a regime change. It is the first live-fire test of a new American strategy for the Western Hemisphere. And almost no one is talking about the economic mechanism behind it. Most people think U.S. power comes from the Marines or the Navy. But the real power lies in the plumbing of the global financial system. It lies in the SWIFT codes, the correspondent banking networks, and the insurance contracts written in London and New York. This operation was a signal. It was a message sent directly to Brasilia, to Mexico City, and to Beijing. The message is simple. You can trade with China. You can sign infrastructure deals with the Belt and Road Initiative. You can even accept diplomatic visits from Beijing. But you cannot touch the currency system. The moment you try to build a financial architecture that bypasses the US dollar in America's backyard, you will be disconnected. This is the birth of the financial Monroe Doctrine. For 2 decades, we have watched China buy up ports, mines, and power grids across South America. We have seen trade between China and Latin America explode to over $500 billion a year. We have seen Chinese companies build bridges in Panama and dams in Ecuador. But there is one statistic that tells you why the United States is still the hegemon. According to the latest Federal Reserve data from July 2025, 96% of export invoicing in the Americas is still done in US dollars. 96%. That is a staggering monopoly. That means despite all the speeches about BRICS, despite all the talk of a multipolar world, when it comes time to pay the bill, everyone still needs dollars. And that is exactly what the United States is moving to protect. Because if that number drops, if it falls from 96% to 80%, or 70%, the American capacity to finance its own debt evaporates. Today, I am going to walk you through the invisible war that is happening right now. Not on the battlefield, but on the balance sheet. We are going to look at the specific mechanisms the U.S. uses to choke off alternative currencies. We will examine why the Petro-Yuan is failing to launch in Latin America. And we will explain why this matters for your portfolio, your currency, and the future of the global order. The mechanism, the invisible choke point. To understand this war, you have to stop thinking like a soldier and start thinking like a banker. Modern economic warfare is not about blockades in the traditional sense. You don't need a destroyer to stop a ship. You just need to cut off the insurance. You don't need to bomb a central bank. You just need to revoke its correspondent banking license. Let's break down how this actually works, because the details matter. When a country like Venezuela sells oil, or Brazil sells soybeans, they don't just hand over cash. The money moves through a complex digital ledger system. If Venezuela wants to sell oil to China and get paid in yuan, it sounds simple on paper. China sends yuan, Venezuela sends oil. But in reality, it is a logistical nightmare. Why? Because of something called correspondent banking. Most banks in South America do not have a direct line to banks in Shanghai. They don't have enough liquidity in Chinese yuan to settle large transactions instantly. If a Brazilian bank wants to receive yuan, it usually has to go through a clearing bank. And where are the world's biggest clearing banks located? New York, London, Frankfurt. Almost every major intermediary bank in the world clears its transactions through New York. This is the choke point. The United States has jurisdiction over every single transaction that touches a U.S. bank account or passes through a U.S. server, even if the trade is between Brazil and China. If the money moves through a dollar clearing account in Manhattan for even a millisecond, the U.S. Treasury has jurisdiction. This gives Washington the power of secondary sanctions. This is the nuclear option of economic statecraft. It works like this. The U.S. Treasury doesn't just sanction the bad guy. They tell every bank in the world, if you do business with the bad guy, you cannot do business with us. You lose access to the US dollar. You lose access to SWIFT. You lose access to the American consumer market. For a bank in Brazil or Panama or even Europe, that is a death sentence. Imagine being a bank in Sao Paulo. If you lose your ability to transact in dollars, you cannot process payments for Visa or MasterCard. You cannot help your local companies import iPhones or Ford trucks. You effectively cease to function as a modern financial institution. So, they will drop a client in a heartbeat rather than risk losing their dollar access. This creates a firewall around the Western Hemisphere. It makes it functionally impossible for a parallel financial system to take root. We saw this play out in real time with Venezuela. Maduro thought he could switch to the yuan. He thought he could join China's cross-border interbank payment system, or CIPS. But CIPS only handles about 4% of global trade finance. The US dollar handles over 84%. The difference in scale is not just a number. It is a wall. By removing the regime in Venezuela, the US didn't just change the government. They reset the operating system of the country's energy sector. They ensured that the largest oil reserves on the planet will remain denominated in dollars. They ensured that those reserves will essentially serve as collateral for the dollar system, not a battering ram against it. This is strategic denial. It is the economic equivalent of seizing the high ground before the battle even starts. The battleground, Brazil, Mexico, and the trap. Now, let's look at the other players on this board. Because this message wasn't just for Caracas, it was for Brasilia. Brazil is a member of BRICS. President Lula has been very vocal about wanting to move away from the dollar. He has called for a common BRICS currency. He has signed agreements with China to trade in local currencies. On the surface, it looks like a rebellion. But look at the hard data. Despite all the rhetoric, the vast majority of Brazil's trade is still settled in dollars. Why? Because Brazil is trapped by its own success. Brazil is a massive exporter of commodities: soybeans, iron ore, oil, beef. These are global markets. And global markets are priced in dollars. If a Brazilian soy farmer sells to China in real or yuan, they take on massive currency risk. What if the real crashes next week? What if they can't convert those yuan into tractors from John Deere or chemicals from Germany? The dollar offers stability and liquidity that no other currency can match. Furthermore, Brazil's corporate sector is heavily indebted in dollars. They have borrowed billions from Western banks to expand their operations. They need dollar revenue to service those debts. They switch their income stream to yuan, and the yuan devalues against the dollar, they go bankrupt. The US knows this. The financial Monroe Doctrine leverages this debt trap. It quietly reminds the Brazilian elite that their wealth is tied to the American system. If they stray too far, the credit lines dry up. The interest rates on their sovereign debts spike. The cost of insurance for their shipping fleets goes through the roof. Then there is Mexico. Mexico is in an even tighter bind. Mexico has benefited huge from nearshoring. Companies are moving factories from China to Mexico to be closer to the US market. But this integration comes with a leash. The US-Mexico-Canada Agreement, or USMCA, has specific clauses that allow the US to review any trade deal Mexico makes with a non-market economy. That is code for China. Clause 32.10 of the USMCA basically gives Washington a veto over Mexico's trade policy with Beijing. If Mexico tries to integrate its financial system with China, the US can blow up their entire economy by closing the border to trade. The peso is practically a derivative of the dollar at this point. And then we have the case of the Chanquay port in Peru. This is often cited as the biggest victory for China in the region. A massive deep-water port, built and owned by COSCO Shipping. It is designed to ship copper and soy directly to Shanghai. It is 3.6 billion Australian dollars investment that gives China a direct foothold on the continent. But here is the catch. Building a port is engineering. Operating a global shipping hub is finance. Who insures the ships that dock there? Maritime insurance is dominated by Lloyd's of London and Western firms. Who issues the letters of credit that guarantee the cargo? Western banks. If the U.S. decides to designate that port as a security risk or sanctions the entities operating it, the insurance evaporates. A ship without insurance cannot dock in most harbors in the world. It becomes a ghost ship. This is the invisible leverage. We are seeing that the physical infrastructure China builds is vulnerable to the financial software the U.S. controls. China can pour concrete, but the U.S. controls the flow of capital that makes that concrete profitable. It's a liquidity trap. Why the yuan fails. This brings us to the core failure of the anti-dollar movement. It is called the liquidity trap, and we have a perfect case study to prove it. Russia. Since the sanctions hit in 2022, Russia has tried to pivot its trade to Asia. They started selling oil to India in rupees and to China in yuan. It seemed to work for a while, but by early 2024, reports started coming out. Russia had accumulated billions of dollars worth of Indian rupees, and they were stuck. They couldn't spend them. India doesn't export enough goods that Russia wants to buy, and the rupee is not fully convertible on global markets. UQI and take a pile of rupees and go buy factory equipment from Germany or electronics from South Korea. So, the money just sat there, losing value to inflation. At one point, there were tankers full of so-called crude sitting idle in the ocean because the payment mechanism broke down. The same thing happened with the yuan. While the yuan is more useful than the rupee, it is still a controlled currency. Beijing strictly manages its capital account. You cannot just take billions of yuan out of China and convert it freely into other assets without government approval. This scares the elites in Latin America. Imagine you are a Venezuelan general or a Brazilian billionaire. You have spent your life accumulating wealth. Do you want that fortune in a currency that is trapped inside China's banking system? A currency that can be devalued by a party decree overnight? Or do you want it in US dollars, which can be spent anywhere from Tokyo to London to Dubai? Cash is king, and the king is still the dollar. The intervention in Venezuela was a reminder of this reality. It was a demonstration that the U.S. is willing to use force to prevent a closed-loop energy system from forming. A closed loop where China buys oil in yuan and Venezuela buys Chinese goods in yuan, bypassing the dollar entirely. That is the nightmare scenario for Washington. Because if that loop closes, demand for the dollar drops. If demand for the dollar drops, interest rates in the U.S. rise. The cost of funding the American government becomes unsustainable. The U.S. deficit is currently running at nearly $2 trillion a year. We need the world to buy our debt. We need the world to need dollars. So, the U.S. smashed the loop. They removed the political leadership that was trying to close it. And they are currently reinstalling a leadership that understands the rules of the game. The rule is, you can sell your oil to whoever you want, but the transaction clears in New York. The long-term cost. So, does this mean the dollar is safe forever? Does this mean the U.S. has one? In the short term, yes. The financial Monroe Doctrine is effective. It has successfully checked China's financial expansion in the Western Hemisphere. It has spooked the elites in the region back into line. Markets love it. The certainty of dollar dominance keeps bond yields lower than they otherwise would be. It keeps the cost of imported goods in America cheaper. But there is a cost to using your currency as a weapon. And that cost is trust. For 70 years, the dollar was seen as a public utility. It was the neutral reserve asset of the world. But now it is seen as a political weapon. Every time you weaponize the SWIFT system, you create more fear. You force neutral nations to look for alternatives, even if those alternatives are inferior. You accelerate the fragmentation of the global economy. We are moving toward a world of two distinct financial blocks, a dollar bloc centered on the US and its allies, and a fragmented Eurasian bloc, trying desperately to build a plumbing system that doesn't go through New York. This bifurcation is going to be messy. It means less efficiency, means higher transaction costs. It means more friction in global trade. For now, the Eurasian plumbing is leaky, slow, and small. But the more the US squeezes, the harder they will work to fix it. Countries are realizing that holding dollars is a liability if you disagree with US foreign policy. So they are diversifying, not into yuan, but into hard assets. This victory in Venezuela buys time. It buys the United States another decade, maybe two, of undisputed financial hegemony in its own hemisphere. But it does not solve the underlying problem. The problem is debt. The problem is a domestic economy that relies on the privilege of printing the world's reserve currency. We are fighting to protect that privilege because without it, our standard of living would look very different. That is why this operation happened. It wasn't about democracy. It wasn't about human rights. It was about defending the credit card of the American empire. It was about ensuring that when we print a dollar, the world still has to accept it. Conclusion, and what comes next. So, what should you be watching next? Don't watch the speeches at the UN. Those are just theater. Watch the central banks. Watch the gold reserves. Countries that are afraid of the financial Monroe Doctrine are doing the only thing they can do. They are buying gold. Gold is the only neutral asset left. It is the only money that isn't someone else's liability. You can't trust the dollar because of sanctions. And you can't trust the yuan because of capital controls, you go to gold. We are seeing central bank gold buying hit record highs. China, Poland, Singapore, India. They are all loading up. This is the silent protest against the weaponization of finance. For the individual investor, the lesson is clear. The US government is playing hardball to protect the dollar. They are willing to topple governments to keep the system intact. That means the dollar will remain strong against other fiat currencies for the foreseeable future. If you are betting on the collapse of the dollar next week, you are going to lose. But it also means the volatility of the system is increasing. The tension is rising. The springs are being compressed. We are living through a period of financial total war. And in war, you need insurance. The US has secured its insurance by locking down South America. You need to secure yours. In our next video, we are going to dive deep into that specific topic. We are going to look at the battle between gold and the dollar. We will analyze why China is dumping treasuries to buy bullion. And we will explain what that means for the purchasing power of your savings in the next 5 years. The game is changing. The rules are being rewritten. And the only way to win is to understand the new playbook. I'll see you in the next report.